Now let's see. Let's see. If we add up these deductions, we get carry the 3 divided by 4. So we take. Amazing. It's absolutely amazing, but under the right circumstances, a producer could make more money with a flop than he could with a hit. Yes, it's quite possible. If he were certain that a show would fail, a man could make a fortune.
Yes?
Yes, what?
Yes, what you were saying. Keep talking.
What was I saying?
You were saying that under the right circumstances, a producer can make more money with a flop than he could with a hit.
Well, yes, it's quite possible.
You keep saying that, but you don't say how.
Well, it's simply a matter of creative accounting.
Cooking the books, aggressive accounting, fraud, cheating, lying, stealing, whatever you call it, can land you in plenty of trouble, up to and including prison time. And it's not just the top officials who end up on the wrong side of the law. Just ask Betty Vinson, housewife, soccer mom, PTA president, and bookkeeper at WorldCom. She was sent to prison along with the top bosses in the WorldCom scandal. What did she do to deserve this punishment? Made the fraudulent entries to the books as instructed by her superiors. In a review of the top 10 accounting frauds reported by Forbes magazine, almost all of them had something to do with the reporting of revenues and then expenses to present a profit picture different than the truth. It is important to understand the proper process for recognizing revenue and expenses. It might keep you off of a diet of bread and water someday. There are some very important concepts to be aware of when considering revenue and expense recognition. First, let's remember that we are talking about the accrual method of accounting. In this method, business transactions are recorded when they occur, not when the related payments are received or made. This is fundamental to the usefulness of financial accounting information. The literature says that revenue can be recognized when either the revenue is realized or realizable and the revenue is earned. On the surface, this seems easy enough to decipher. However, it gets complicated because there is still judgment involved and contractual elements involved in determining when these criteria have been made or have been met. The literature further defines realize as being measurable, collection is assured, and fulfillment costs can be estimated reasonably, reliably, and accurately. Earned revenue is described when the company has completed all or substantially all of the product or has delivered the service. The sale is complete with risk of ownership having been transferred. Revenues can be recognized when an order is received, when an order is accepted and terms are finalized, when goods are delivered, or when the customer is billed, or when payment is received. Commission salespeople in marketing want sales to be recognized early, while the finance and accounting department want to be the most conservative and pick a point further down the road. The expense recognition principle, also known as the matching principle, says that the products produced and sold or services rendered to generate revenue also create related expenses. The expenses must be matched with related revenue for the period so that the income statement shows the revenues earned and expenses incurred in the same accounting period. In general, there are two types of cost: product and period cost. Product cost can be tied directly to products and in turn revenues. Period cost, on the other hand, cannot. These period costs include things like administrative salaries, office supplies, etc. They are difficult to match to a specific revenue stream. These expenses are recorded in the period in which they are incurred. Expense recognition further gets complicated when the expense versus capitalization question is broached. Companies capitalize the cost of asset purchases in order to spread out the cost of the assets over many reporting periods. This way, net income is not affected disproportionately in the period in which the asset was purchased. Most companies will have a capitalized or CapEx policy. There is usually a useful life of more than a year and a minimum dollar included in these policies. At one company I worked for, all items were capitalized that had a useful life of greater than a year and were over $5,000 in value. This amount seems to be getting lower and lower, and I'm not sure if this is due to company internal policy, FASB, or tax law. So what starts off relatively straightforward gets murky when you further describe criteria with words like measurably, assured, estimated, substantial, and transferred. As you can see, a lot is left up to interpretation and judgment.